Okay. So yesterday we looked at basic earnings per share. The basic earnings per share is the actual earnings per share. Okay, the actual earnings per share. Okay, but we want to look at something. Okay, assuming our basic earnings per share is now 10.8, 10.8 pesos per share now. Okay, and the entity is having warrant, or share options. So let's say the entity is having share warrants. Okay, share warrant or share options, any of them. Okay. So the entity is now giving the shareholder, all the shareholders are having share warrants, which they have the what? They have the option or they have the right to exercise at a particular date, let's say 3 years from now. Okay. And they are saying that the exercise price will be the exercise price for this particular, let's say it is 5 cedis per option. Okay, 5 cedis per option. And the question will be telling you, let's see, average, the average market price of the entity is 7 cedis currently. Okay, the average market price of the entity is 7 cedis. Okay, you can see that all things being equal, if the price should remain the same, the option, okay, this to be per share. Okay, the option should have been bought at what? 7 cedis, all things being equal. The option should have been bought at 7 cedis. Okay. Although the options will be exercised in a future date, which might be 3 years from now or 2 years from now, the options should be bought at what? 7 cedis, which is the current market price. But they are going to be buying the options at what? At 5 cedis. Okay. Assuming the option will be exercised. Okay, assuming the options will be exercised at a future date, what will be the impact of that particular option on our current earnings per share? Okay, the market price is 7 cedis and the options will be bought at 5 cedis. You can see that the entity is actually issuing the options at a price which is 2 Ghana cedis less than what? Than the market price. This is assumed to be a bonus issue. Okay. This is assumed to be a bonus issue relating to the what? To the option. Okay, although the options will be purchased at a future date. If they are going to be purchased at the same amount or at an amount higher than the market price, we are not giving them any shares for free. Okay, so we are saying that assuming the options to be exercised now, what will be the impact on what? On our current earnings per share? Okay, what will be the impact on our current earnings per share? That is it going to be reducing it or is it going to be increasing it? That's what we see dilutive. Is it going to be decreasing our current earnings per share? If it is going to be decreasing it, we say that it is going to be dilutive. Okay, so the diluted earnings per share is just an assumption that those things that are going to be what? That are going to be converted into equity shares in the future, assuming they should be converted now, what will be the impact of those things on our what? On our current earnings per share? The entity will be having convertible, the entity will be having convertible preference shares. Okay, these convertible preference shares will be converted at a future date. Okay, the question is, assuming this particular convertible preference shares are converted, what will be the impact if they are converted in the future? What will be the impact of it on the current what? On the current earnings per share, on the current basic earnings per share, or assuming the convertible, this particular instrument is converted now, what will be the impact of it on the current earnings per share? So for this part, the diluted earnings per share is just an assumption. It's not the items or the instrument that we are going to be using are not going to be converted now, but we want to estimate the impact of that particular potential what? Ordinary shares or the potential ordinary instrument. What will be the impact of them on our current earnings per share when they have been converted in the future? So we want to let our shareholders know that, okay, if this particular convertible or the conversion option is exercised, it is going to be decreasing our what? Our earnings per share. It is going to be decreasing our earnings per share. So that is basically about the diluted earnings per share. So we want to know those potential ordinary shares, assuming they are to be converted now, what will be the impact of the conversion on our current earnings per share? Is it going to be reducing it? Is it going to be increasing it? Okay, so we are going to be using two two or three instruments. Mostly we use the share options. The only thing that is going to be diluting or having effect on the earnings per share is the share options, because the share options will be when if it is being exercised, it will now be turned to what equity shares in the future. What will be the impact of it on our current earnings per share? If you have convertible preference shares, if they are going to be converted to equity shares in the future, there will also be a preference. There will also be ordinary shares, and we also have the convertible loan notes. Okay, convertible loan notes. So that is basically what we talk about this one. Okay, so if our share options, okay, the question will give you the options. Okay, what will be if the options are to be converted now? What will be the impact of it on our current earnings per share? Okay, so assuming we have the options, I don't have the currency figures here. Okay, so how do we calculate our diluted earnings per share? Okay, diluted earnings per share will just be our earnings that we have used to calculate the basic earnings plus any notional, okay, plus uh notional, okay, plus notional profit or savings or whatever will be the case over there, divided by our current weighted average number of shares that we have used. Okay, we are just looking for the impact on plus any notional what ordinary shares. Okay, that is what we do. So we'll be having our, so the instrument that we use is, we use the first instrument that we are going to be considering is share options or warrants. Okay, share options or warrants. Okay, the share options, what we do is that the people are given the right, okay, to buy shares or additional shares in the future. Okay, but the question is, what is the amount that they are going to be what? They are going to be buying this particular what instrument? What is the amount that they are going to be exercising this option? Okay, so let's say that they have 2,000 options now, 20,000 options. So they have the right to purchase 20,000 options at a price of 5 CD. Okay. But the market price of the entities, the market price of the entity share is 7 CD. Okay. Is 7 CD. So the option is 5 CD and the market price is what? Is 7 CDs. Okay. The question is, assuming these people are going to be what? Exercising the option now. They will be buying at what? Uh they will be buying at 5 CD, whilst the market value is 7 CDs. So there will be a bonus element of what? 2 CDs there. Okay, there will be a bonus issue of 2 CDs there. Okay, so the 5 CD will actually be bought in the future. But what is going to happen is, assuming they should exercise this now, okay, there is going to be a bonus element of what? 2 CDs. Okay, what will be the impact of these 2 CDs? So we only calculate the bonus that will come in there. They are not paying for 2 CDs of the options. This particular 20,000 should be bought at 7 CDs, all things being equal. So we have the 2/7 multiplied by the option, which will give us the 20,000. Then the answer over there is the nominal shares. or the notional shares that we are going to be having. So 2/7 multiplied by 2/7 multiplied by 20,000. So 574, 574. Okay, 574. For share options, we are not going to be having any profit or any notional profit that will be coming from that place. So for the options, is purely dilutive. It is going to be affecting our basic earnings per share. So we just look for this one. It will be bought at the future at 5 cedis. Okay, it will become available. It will become available when it has been bought. But if it is being bought, it will be bought at a price lower than the market value. So there's a bonus element over there. So what is the bonus element? What is the impact of the bonus element on our what will be on our current earnings per share? Okay, that is how we go about it. Okay, that is how we go about it. Okay, so let's pick a question on the share option. Then we see what we can do. Question number 4. Auntie Vic.
Yes. Question 4. Company had 8.28 million shares in issue at the start of the year and made no issue of shares during the year ended 31st December 2024. But on that date, there were outstanding options to purchase 920,000 ordinary 1 Ghana cedi shares at 1.7 cedis per share. The average fair value of ordinary shares was 1.8 cedis. Earnings for the year ended 31st December 2024 were 2,208,000 cedis. Required, calculate the diluted earnings per share for the year ended 31st December 2024.
Okay, thank you. So the diluted earnings per share okay. So question number 4, diluted earnings per share. Okay. So diluted earnings per share we see is the earnings plus any notional profit. Okay, this notional profit only works for convertible instruments. Okay, so notional profit or savings or whatever will be the case there, divided by the weighted average number of shares plus the notional number of shares. Okay, so let's come here. What is our earnings from this question? Earnings from the question is what?
2.2208
Okay,
08,000.
okay, 2 points. We have 2,208,000.
08,000.
Okay. What is our weighted average number of shares? Were there any new issue of shares? Were there any issue of shares, bonus issue, rights issue during the year?
No, there's no new issue of shares.
Okay, so our weighted average number of shares is the same as the 8.8 million, isn't it?
Points. Yes, 8.28.
The weighted average number of shares is the one that you have used to calculate the basic earnings per share. So it is just a basic earnings per share that we are looking for the impact of the dilutive instrument on the basic earnings per share. So you have the 8,280,000 plus, okay, then you bring in that particular one now. Okay. But on that day, there were outstanding options to purchase 920,000 ordinary shares, which is going to be the par value is 1 cedi at 1.70 per share. The average fair value of ordinary shares was 1.8. Earnings for the year ended 31 December 2x7 were the 2,208,000. Okay. They said that they were given options to purchase 920,000 at a value of
1 cedi.
1
No,
cedi.
that's not 1 cedi. 1 cedi is a nominal
Oh, okay,
value.
1.70. Yeah.
Okay. But what is the value? What is the average value? What is the market value of the entity shares?
1.8.
Okay.
1.8.
What it means is that you can see that they are buying the shares at At 0.1 less than the
Yes.
market value, isn't it?
Yes.
Okay.
Mm.
So if they buy, this is if they buy, they will pay 1.7 for this one. Okay. And that will be a new issue, and that will have effect from the time that they have exercised this one. But now, if they want to buy, they are going to be buying at a price lower than this particular one. The difference over here is deemed to be a bonus issue, or it's deemed to be giving the shares to them for free. So if this particular options are being exercised, it is going to be having 0.1 as part of the shares, which will be treated as a bonus issue. Okay. But the question is, what is the impact of that on our current earnings per share? So this is what we do. The market price is 1.70. That will become effective when the people purchase. It will be treated as a full market issue, a market issue. Okay. But the difference between the two is how much?
0.1.
Okay, 0.1. So the assumption is that the 920 should be bought at 1.8. But now you are buying it at 1.7. So the value of the shares that you are going to be having in terms of the apportionment is going to be lower than that. Okay. So we come to this one, then we look at the bonus issue. How do we calculate the share option relating to the bonus issue? We do the fair value of the entity shares minus the exercise price divided by the fair value multiplied by the number of options that they are going to be buying, or the number of warrant that they are going to be buying. The difference is just 0.1. So 0.1 divided by 1.8 multiplied by that will give you your. So let's come to the number of the number of options. That will give us 0.1 over 1.8 multiplied by the total options of 920,000. What are we having?
51,111. That is 51,111.
Okay, 51,000. Okay, so we have 511,111. Okay. For options does not bring in any profit. There will not be any savings on profit because we are not paying anything currently. Sometimes you'll be paying interest, and if the instrument is being converted into equity, that interest will not be paid again. The interest will be deducted from profit. So if you are converting that, the interest will not go again. Okay, you will not be paying that interest again, and that will be coming in as a notional profit. But for share options, it's a purely dilutive instrument because it does not bring in any any profit or benefit, or it has not contributed to what our to our profit at the top there. So what are we having for that one? The final answer is what? What are we having as the final answer?
Coming.
0.0265.
No, please.
2.65.
2.65 pesos or cedis.
Pesos. This is 2 CDs, 65 pesos.
2 cedis.
65 pesos. I got 2.65, so it should be 2 CDs, 65 pesos.
26 pesos.
26 pesos.
26.5 pesos.
Yes, please.
Yes.
Okay. So we have 26. The answer that you are getting, which is 0 point, that is in cedis. Okay. Multiply by 100 to have your pesos. So that will be per share. Okay. What you do is the question can ask you to determine your basic earnings per share. So the basic earnings per share will just be your 2208,000 divided by 80,000 shares. What are we having as the answer?
$26.67 pesos.
26 points.
67.
Okay. So 26.67 pesos. You can see that the option is now reducing what? It's now reducing the current earnings per share by what? By, let's say, 17 pesos or something like that, isn't it?
Yes, sir.
Okay, so that is what we want to, this is what we want to tell the shareholders, that if the options were to be exercised now, it is going to be reducing our current earnings per share of 26.67 to what? 26.50. Okay, so let's come here. I want to specify something to you. Okay, assuming this one, okay, this to be purchased at 2 cedis. Okay, will there be any bonus elements relating to this one? Assuming the option should be purchased at 2 cedis. Will there be any, if there should be any, if this should be exercised now, will there be any issue of bonus elements on the what? On the exercise one?
No, sir.
Okay. So if that is the case, you don't consider the option because the option does not have any potential effect on what? On the current earnings per share, because it will be bought at a price higher than the market value. So there is no issue over there. Okay, we only consider the option when the exercise price is lower than what? Lower than the current market price, which means that there will be an element of what? Bonus issue when the options are being exercised. But if you have the option price to be higher than the current market value, there is not going to be any issue there, because both it will be bought at what? Full market value, and they will become effective at the time that they will be what? They will be bought. We prorata them for the time that they have been exercised. So there's not going to be any issue about that. We only consider the option when the price is what? The price is lower, or the option price is lower than the market value. Okay. I saw a hand up.
Yes, sir. Sir, please, I'm getting 2.65,
2 points.
not 26. 65.
Then you have to that one is a specific problem. So you have to try to resolve it. So you have to pick the figures again and punch. Okay. 220,000 divided by 8,280,000 plus 5111. Then you get your answer there. You should be getting 0.26. Multiply by 100, you get 26.50 pesos.
No.
Okay, so I'm okay now.
Okay. So the other dilutive one is we are going to be looking at convertible instruments. So convertible instruments. Convertible instruments. And these convertible instruments, it can be loan notes. Okay. So the loan notes, the question will give you that the entity is going to be, the loan note will be converted at a particular date, and they will give you the conversion what ratio. Okay. What you have to know is that a convertible loan note, currently you are paying interest on it. Currently you are paying interest on the loan note. So if the loan note is 10%, okay, 10% loan note at a value of, let's say, 200,000. Okay. At the end of every year, we are paying interest of what? 20,000 on this particular loan. Okay. We are paying interest of we are paying interest of uh 0.1 multiplied by 200,000. And that will give us 20,000. Okay. Okay. Assuming this has been converted, if this will be converted in the future, if this is converted in the future, okay, if this is converted in the future, what will be the impact of it on our current earnings per share? So we assume that if this is converted immediately, okay, it's just an assumption. It's not something that will happen here, but we want to know the potential effect of this one on our what? On our current earnings per share. If this is converted now, it means that the entity will no longer be paying what? The interest, isn't it?
Yes, sir.
Okay, so this interest will not be taken away from profit again. Okay, you know that interest is tax deductible, so they will take the interest from the profit before we charge what? We charge the tax. Okay, let's come here. Let me show that one now. Okay, so let's come to this particular side. Okay, assuming the profit before interest for the entity, profit before interest for the entity was 50,000. Okay, and the interest expense will be taken away at what? Interest expense will be taken away, and the entity will be having profit before tax of 30,000. Okay, let's assume the entity is paying tax, profit before tax. The entity is paying tax at 25%. What will be the tax that will be paying?
7,500.
7,500. Okay, and their profit will be 22,500, isn't it? Okay, so we are saying that the convertible instrument is now converted into equity share. So we are not going to be paying interest to those people again. And since we are not paying the interest, it means that the interest will not be taken away from the profit again. So what we do over here is that our profit before tax, okay, our profit before tax now will now be the full 50,000. Do you agree?
Yes, sir.
Okay. And the tax expense will now be what?
12,500.
Okay, 12,500. And you'll be having a profit of what?
37,500.
37,500. Okay. Okay. Can we say that the tax expense over here is the same as the tax over there is the same as 0.25 on the previous 30,000? Okay. Plus 0.25 on the new 20,000 that we are not subtracting, because the first one we are not what? We are not paying tax, but now we are going to be paying tax on it. Can you get the same 12,500 from this one?
Yes.
Okay.
Should be
So
the same.
so you can see that we are now going to be paying tax on what?
The
20,000.
interest that you are not paying.
Okay. So if we are paying tax on 0.25 on the interest, because the interest was first subtracted for the profit before they charge the tax. Now we are not paying any interest. It means that the interest will not be subtracted again. Then we charge tax on the full amount. What it means that we are going to be paying tax on the interest that we are not paying. It will not be available for for taxing or for taxation. Okay. So we are paying tax of what? 25% on this. Then the entity will be saving what? Okay. You can see that this
The
37,500 is
75%.
this 37,500 can be calculated as 22,500, which was a profit plus the profit element on what? On the interest now, which is the same as 0.75 multiplied by what? The 20,000. Is that correct?
Yes.
Okay. So if you are doing the convertible notes, convertible loan notes, okay, if you are converting it, the interest will no longer be paid because they are now going to be equity shareholders. So the interest will no longer be paid. If the interest is no longer be paid, you will now pay interest on the what? On the you will not pay tax on the interest because that will not be subtracted from the profit again. So they will charge tax on it. The tax, if the tax is 25%, you pay tax. You are going to be saving what? 75% or 70%. So the profit that we are going to be adding over here, which is a notional profit, will always be after tax profit on the what? On the loan note. Okay. On the loan note. And they will give you how the loan note will be converted. How the loan note will be converted. Before you even include the loan notes in the calculation, you have to check whether the loan note is going to be what? Dilutive. How do we check that? It is checked like this. We normally check whether the loan note is what? Is dilutive, is not dilutive. We pick the profit, which is a notional profit. Okay. We pick the profit, which is a notional profit, divided by the notional shares that we are going to be getting from the conversion there. So let me just use this example. Let's say that our profit is 15,000 and our shares that we are going to be getting is actually 12,500 shares. What would be the answer there?
1.2.
Okay, that would be 1.2, isn't it?
Yes, sir.
1.2. Okay, 1.2 cities. But the question now is, let's assume that our current basic earnings per share is, let's see, is 90 pesos. Okay, you can see that the calculation of this one is 1.2 cities, higher than this one, isn't it?
Yes, sir.
Okay, if this happen like this, it means that this particular instrument it will not have any reduction, any bad effect or any negative effect on what? Our current earnings per share. In that case, we say this particular instrument is anti-dilutive. We don't consider it when we are doing the dilutive earnings per share. We are looking for only those instruments that is going to reduce our current earnings per share. So if it is loan notes, for the loan note convertible ones, you check them because they are coming with what? They are coming with profits. So assuming we are calculating their individual earnings per share, what would have been the earnings per share? We compare it with what? The one that we have, the current earnings per share, to see whether the current earnings per share is higher than that particular one. If it is higher than that particular one, it means that the conversion is going to be having a negative impact on what? On the basic earnings per share. But if this is what? Higher than this one, it means that this instrument is anti-dilutive. We don't what? we don't include it. But if this should be 0.8 or 80 pesos, okay, the 80 pesos is lower than this. It means that if this is converted, it will reduce our basic earnings per share. So we consider this when we are calculating the diluted earnings per share. But for the share options, it does not count with what any profit. So that one is purely dilutive for instrument. Okay. So this is about a convertible loan note. The question will give you the convertible, and as a rational being, you pick the highest one. Okay. Let's count to convertible preference shares before we pick a question on this one. Convertible preference shares. Okay. Convertible preference shares. Okay. So convertible preference shares. The question will give you the convertible preference shares. Okay. But what we have to know is that preference dividends are not what? Are not tax deductible, isn't it? Dividends are declared out of profit. Okay. So what will happen is that if you are converting the preference shares, it means that you are going to be saving their what? Their dividends. But the dividend that they are going to be, we are not going to be paying, will not be subjected to what? To tax. Because dividends is not what? It's not deducted from tax before, it's not deducted from profit before we charge tax. So it's not tax deductible. So for this one, we don't do any after tax savings or whatever, because dividend is not tax deductible. Okay. So we just take the full amount for the dividend. Then we also do this anti-dilutive or dilutive what test on the preference dividend also. That is how we go about this. It's a very simple exercise. Let's try to see if we can pick a question. Then we pick a combination of all the issues together. Okay, let's try the question number 6.
Question 6.
Yes, ma'am.
Domain Limited has 5 million ordinary shares in issue and also had an issue in 2020. 1 million cedis of 14% convertible loan stock, convertible in 3 years at the rate of 2 shares for every 10 Ghana cedis of stock. 2 million cedis of 10% convertible loan stock, convertible in a year's time at the rate of 3 shares for every 5 cedis of stock. 3. The total earnings in 2020 was 1.75 1,750,000 cedis. The rate of income tax is 35% required in accordance with IAS 33 earnings per share. Calculate the basic and diluted earnings per share.
All right. So they are asking for the basic and what? And the diluted. So the basic is going to be very simple here. The basic is the earnings per share calculated on actual earnings and also the actual number of shares at the reporting date. So we have the question number 6 there, which is okay. So we have the basic earnings per share, which will be calculated as the earnings. Okay, the earnings and then the actual number of shares that contributed to that particular earnings. So we have the weighted average number of shares. Okay. So for this one, for the basic earnings per share, we are looking at the current earnings per share, which is going to be affected by bonus issue, right issue, market value. What is those earnings per share based on the current shares in issue? That is a basic earnings per share. So what is the earnings over there? What is
1,750,000.
1,750,000. Okay. What is the number of shares in issue now?
5 million.
5 million. There was no bonus issue. There was no market value. There was no right issue. So this will give us the weighted average number of shares. That will be the shares. So 5 million. What are we having?
35 pesos.
35
Pesos.
Okay. So we have 35 pesos per share. Okay. That is our current earnings per share. Okay. Then let's come to the issue of what? Of the convertible. Okay. What we have to do is that we have to take the convertible instrument one by one to test them to see whether they are dilutive or they are anti-dilutive. Okay. If we are converting the one that is 1 million, okay, what will be the interest savings on this particular one? It is 1 million and we are paying interest currently at 14%.
14%.
Okay, so let's calculate our interest savings. So let's see the loan note. We take the first one as a loan note one. Okay, so our interest, which will be after tax interest, okay, after tax interest will be equal to 0.14 multiplied by 1 million multiplied by what? 0.65. Is that correct? Look at it. Is it 0.65, which is 65%?
Yes, the tax rate is 35, so that's
Okay.
right.
So what will be the amount that we are going to be getting from that particular side now as the notional profit?
That's 91,000.
So 91,000. Okay. What is the number of shares that we are going to be? What will be the number of shares? Let's look at the conversion rate over there also. Okay. They are saying that this will be convertible in 3 years' time. We are just assuming that if it is converted now, what will be the impact? So we want to estimate the future impact of this particular conversion on our current earnings per share, so that the shareholders will know that if in the future the earnings per share is reducing, they will know that it is the impact of what? Of the instrument that we have now. Okay. So this will be converted in 3 years' time at a rate of what? 2 shares for every 10 cedis. So 2 shares is equal to what?
10 cedis.
10 cedis. Okay. But how much do we have over there? We have 1 million.
1 million. Yeah.
So if 2 shares is equal to 10 cedis, how many shares will be 1 million?
200,000.
That will be 200,000. Okay. A very simple ratio and proportion. So we have 2 over 10 multiplied by 1 million. I hope that is correct.
Yes, sir.
Yes.
Okay. So, and we have the number of shares to be 200,000. Okay. 200,000 shares. So what we do is that we check to see whether it is dilutive. So you calculate your impact. Okay, you can say it's basic earnings per share or whatever. That will be 91,000 divided by what? 200,000. What are we having?
45.5.
45.5 pesos.
45.5 pesos. Is it going to be reducing our current earnings per share if it is converted?
Yes.
No.
Yes.
Okay, so this is anti-dilutive. You ignore. Let's come to the loan note 2. The loan note 2, our interest savings after tax interest will be, let's go there. Okay, that will be 10% on 2 million, isn't it?
Yes, sir.
Multiplied by 0.65. So we have 0.1 multiplied by 2 million multiplied by 0.65. What are we having?
130,000.
130,000. Let's come to the number of shares that we are going to be getting from this. So using the same
Question.
proportion. Yes, please.
So the one we are calculating, the interest, is it the notional profit or?
Yeah, is the notional profit. We are paying the interest
Okay.
after profit.
Okay.
So we come to, all right, what would be the conversion proportion? 3/5 multiplied by 2 million, isn't it?
Yes, sir.
Okay, 3/5. So we have 3/5 multiplied by 2 million. What are we having?
1.2 million.
Okay, 1.2 million. Okay, 1.2 million shares. Okay, so let's check whether it is dilutive. So we have 130,000 divided by 1.2 million. What are we having?
10.83 Ghana pesos. Diluted.
10.83 pesos. You can see that it's lower than what?
The
Our
basic.
basic earnings basis.
Okay, so that is dilutive. We include that one in the calculation of the diluted earnings per share now. So you come to this one. Okay, we are just looking for the impact on the current earnings per share. So you use all the items that you have used to calculate the earnings per share and add the what? Those one that will be increasing now. So it means that we assume that if the conversion should be done now, we are going to be saving interest of this and our shares will be increasing by that particular amount. So what will be our new earnings per share? That is what we call the dilutive. Okay. So we have the 1,750,000. Okay, plus 130,000, isn't it?
Yes.
Okay, divided by
5
5
million.
million.
That's 1.2 million.
Okay, 5 million plus 1.2 million. So the top there will give us what?
1,880,000.
We have 1,880,000 divided by
6.2 million.
6.2 million. Okay.
£30.32.
30.32 pesos.
Okay, 30.32 pesos per share. Okay. So that is a diluted earnings per share. Yeah, a hand is up.
Yeah, Isaiah,
Yeah.
please, can you shed light on the number of shares, how you got it using the proportions? I didn't understand.
Which of them?
The loan notes,
Is it loan
loan
note
note,
1 or 2?
both of them, please.
Okay. Were you there before we calculated them or you just joined?
I was there before you calculated, but I didn't understand how you did the proportion.
Okay, but you heard I say two shares is equal to 10 cities.
Yeah, 2 shares equal 10 cities, but
1 million will be
equating
what?
it,
If 2 is 10, 1 million will be what?
if 2 is 10,
Yeah, 1 million will be what?
so 1 million will be,
The 2 is the shares. Okay, the 10 cities is the price. So 2 shares is equal to 10 cities. How many shares will be equal to 1 million Ghana cities?
so wouldn't it be the 1 million shares over the 2 shares times the 10
No,
cities
please.
or what?
No, please. 2 cities is equal to 10 cities. How many shares will be equal to 1 million? 2 is equal to 10 cities. How many shares will be equal to 1 million?
Please, I'm not, I don't know how.
I think you just cross multiply and get your answer.
Have
Yes. So
Okay.
it will be 2 times the 1
You
million
cross,
divided
you
by 10.
cross multiply.
Okay. Yeah.
2 times 1 million divided by 10.
Okay. Thank you.
Zina, don't worry. The last time I did mathematics was like 30 years ago. So it's not your fault. So, Sini, I hope you're okay now.
Yeah, I'm okay. I'm okay.
Okay.
I'm
So it's
okay.
a very simple ratio and proportion. Okay. Okay. Let's let's pick additional one question on this one. Then we
Okay.
pick a complex question now. Did I say something about share split? Question number 15. Did I say something about share treatment or share split?
No.
Oh, really? The time I was saying bonus issue, I said something about share split. Okay, maybe I said it and you didn't pay attention. Share split is also treated as if is also treated in line with what? With the bonus issue. So share split is just like you are now what? The shares were valued at 2 cities, and you are now the shares are valued at 2 cities, and you are now splitting it, let's say 1 city, 1 city. Okay. So the number of shares will increase, but just that the value will still be the same. Okay, so it's just like the one that we have done that we see that the market value was 10 cities and they have done 100% bonus issue. You have seen that we have splitted the shares to be 5 city, 5 city. That is the same as share split. So share split is the same as what? Or share split or stock split is the same as what? It's treated like a bonus issue. It will have effect from the time that the shares have been issued. Okay, that is question number 15. Let's pick that one. Then we pick at least two combined questions. Then we know that we are done.
Question 15.
Yeah.
The Lynx has 12 million ordinary shares and 4 million 5% convertible bonds in issue as at 31st December 2002. There have been no new issues of shares or bond for several years. The bonds are convertible into ordinary shares in 2003 or 2004 at the following rates. 1. At 30 shares for every 100 Ghana cedis of bond if converted at 31st December 2003. 2. At 25 shares for every 100 cedis bond if converted at 31st December 2004. There are outstanding shares options on 400,000 shares, which can be exercised at a future date at an exercise price of 25 cedis per share. The average market price of shares in the Lynx during 2003 was 40 Ghana cedis. Total earnings for the year to 31st December 2003 were 36 million cedis. Tax is payable at a rate of 30% on profits. Required compute basic earnings per share and diluted earnings per share for the year ended 31st December 2003.
All right. Thank you. So you can see that this question is a combination of uh options and was and convertible, isn't it?
Yes,
Okay.
sir.
These are dilute. These things are not going to be in existence now. They are not going to be adding to our current number of shares. So they have no effect on what our current earnings per share. Okay. But we will just want to know what will be the impact in the future. That's what we call a dilutive one. So our current earnings per share, which is the basic earnings per share, there is no right issue, there is no new market issue, and there is no bonus issue, isn't it? So that will be
Yes, sir.
our current ordinary shares in issue and the what? The profit for the year. Okay. So our earnings for the year is what?
36 million.
Yeah, that's it.
So our current earnings per share, okay, basic earnings per share, which is the first one, will be 36 million divided by, what is the number of shares?
12 million.
12 million.
Okay, 36 million divided by 12 million shares. And that will give us,
3 cities per share.
please don't multiply the 3 cities by 100. Okay, as soon as it is in whole number, that is it. If it is in decimal, that is what we multiply, because the earnings per share should be calculated in the highest denomination of the currency. So if that is 3 cities, that is fine. So 3 cities per share. Okay. Then let's come to the diluted earnings per share. So the diluted earnings per share, we'll still be having our 36 million, isn't it?
Yeah.
Yes, sir.
Divided by 12 million. Then we'll be adding certain figures that are to be added. Okay. Let's come to each of them. You know that the options is going to be what? The option is entirely what? Dilutive. So let's calculate the options now. What is the exercise price for the option?
25 cities per share.
Okay. And what is the market price?
40 cities.
So what is happening there?
A bonus of 15
A
cities.
bonus of 15 cities.
Okay. So let's calculate the impact of that particular 15 cities. So we have the share options here. Okay. That will be 15 over 40 multiplied by 400,000. Is that correct?
Yes.
Okay. What are we having?
150,000.
150,000.
Okay. So we have 150,000. That will be added over here as 150. So this one, there is no test because there is no benefit coming as a result of this one. Okay. But let's now come to our convertible. Let's now come to our convertible loan notes now. Okay. We be having, okay, someone say, let me mention notional what? Notional profit. So let me write the notional profit here. Okay. So the notional profit will be the what? The interest rate multiplied by the amount multiplied by what?
The
By the
tax rate.
after tax interest rate. Okay. The the value is now 4 million, isn't it?
Yes, 4 million.
Which we are paying interest of what?
5%.
5%. So we have 0.05 multiplied by 4 million,
Times 0.7.
0.7. What are we having?
140,000.
140,000.
140,000. Okay, let's look at the notional shares also here. Okay, what will be the notional shares? They have given us this one. This one you look at what? You will be a
The
rational
year.
person over here. Okay, the year is not necessary. Just be a rational person. Okay. If you are the bondholder, which of these options are you going to be picking?
The
30
25
shares.
shares for every 100 bonds.
You take 30 shares for every what?
100 bonds.
Every 100. Okay. It just be rational. We are looking for the instrument that is going to make it dilutive. So the dilutive, you pick the highest one because we want the one that will be at the down. The down should be what? Should be the highest. Okay, the denominator should be the highest one. So even if you don't want to be rational, since we are saying that the instrument should be diluted, it means that we should have a higher number of shares. So which of them will give us the highest number of shares that will make the instrument what dilutive? Okay. Or if you have this one, just pick the highest one. It doesn't matter. Pick the highest one. So you are going to be converting early as possible so that you can have a higher number of ordinary shares. Okay. You are a rational uh, investor. So let's come here. They say that 30 shares for every what?
100 cities.
So
bonds.
30 is equal to 100 cities. How many shares will be equal to 4 million?
1.2 million.
Okay. So we'll be having 30 over 100 multiplied by 4 million. Is that correct?
Yes.
Okay. So what are we going to be having there? 1.2 million.
1.2 million. Yes.
Okay. So 1.2 million shares there. So we can check to see whether it is dilutive. So 140 divided by 1.2 million. What are we having?
11.67 pesos.
11.67 pesos.
So it means that what?
It's very
Dilutive.
diluted.
It is very dilutive. Thank you. So the earnings per share was actually what? 3 cents.
Three
Now we are
3
having
cities.
our, so we add this one. We have the 1.2 million here as the shares. Then we add the 140,000
140,000.
there. The total give us what? 30,000, 36,000 plus 1,100.
I'm having 14.17.
14.
0.17.
Okay, someone should confirm that for us.
It's 2 cities. 71 pesos.
2 cities.
71 pesos.
Yes.
Okay, 2.707. Okay.
707. Wow. Yes.
Okay. So senior, you have to send a calculator back to where you bought it. 371. Yes. Okay. So we have the 2.71. Yes. Okay. So that is a basic one about the, so we are going to be picking combined questions where you can have bonus issue, right issue, and all those ones. So we solve 2 questions of that nature. Then we know that we are done with this particular one. So let's pick a question where we can have the combination of all of them. How do you go about them? Okay. How do you go about them? Let me see. I have that question. Okay, let's take the question number 3. Aunt Vic.
Yes, please. Question
Okay.
3.
Yeah.
On 1st March 2015, Jamesi PLC had 30 million issued equity shares. On 31st May 2015, the entity issued at full market price 6 million equity shares. On 31st December 2015, the entity made a right issue of 1 for 6 at 7 Ghana cedis. The fair value of the shares on the last day before the issues from the rights issue was 10 Ghana cedis. Earnings after tax for the year ended 28 February 2016 was 16.4 million cedis. The reported basic earning per share for the comparative period was 23 pesos. Require calculate the EPS for the year ended 28 February 2016 and the restated EPS for the comparative period.
Okay, so you can see that this is a question having what full market issue and also what a right issue, what a right issue, isn't it?
Yes, sir.
So this is how you'll be seeing some of the questions. Or but this can be financial reporting question, but a corporate reporting question. If we solve one, then you know that is a corporate reporting question. So on 1st March 2015, Jamasi PLC had 30 million equity issued equity shares. On 31 May 2015, the entity issued at a full market price 6 million equity shares. On 31 December 2015, the equity made a right issue of 1 for 6 at what? At 7 cedis. The fair value of the shares on the last day before the right issue, before the issues from the right issue was 10 million. Earnings after tax for the year ended this and this is this particular one. So they're asking us for the basic earnings per share. Okay, so let's go and kill that one. Question number 3. We have Jamasi PLC. Okay. So we are looking for the basic earnings per share. So our basic earnings per share is our profit after tax because we don't have any irredeemable preference dividends here. So we have profit after tax divided by the weighted average what number of shares. What is our profit after tax given in the question?
16.4 million.
Okay, 16.4 million. Okay, 16.4 million. Okay, so let's come to the weighted average number of shares. So the weighted average number of shares, we are going to be using the possible one that we know. Okay, so we use the way I've done 3 the last time, but I will use only 2. You pick the one that you like. Okay, let's come here. Let's come to our own over here. We need to have so we do it one by one. We apply the right issue fraction up to the time of the right issue, a very simple one. Okay, if you like that one, you pick it. If you don't like it, you use another one, then you pick that particular one. Okay. When was the full market issue made?
31st May.
May.
Okay, but the starting of the year is what? 1st March, isn't it?
1st March.
So it means that the entity, the 30 million has done 2 months before what? The issue of the full market value, isn't it?
No, 3 months.
Is it 3 months? March, April. Yeah, it's too much. It's only 2 months.
The date was 31st.
Oh, okay, sorry. That would be 3 months. Okay. So we'll do it one by one. We have March to what? To May, isn't it? Okay, so we have 30 million here. We come and multiply. Okay. Then May to when? When was the right issue made?
31st December.
The right issue was 31st December. Okay, so from 1st June to 31st December, how many months is that?
7.
Okay.
7 months.
7.
It's 7. Okay. So we do, but at that particular time, how many shares will be there? From June to 31st December, how many shares will be there before the
36 million.
okay, that will be 36 million. Okay, so that will be 36 million. So we come to June to December. Okay, that will be 36 million. We come and multiply. We come and do what we have to do. And January to what? To February. That will be 2 months, isn't it?
Yes.
Okay, January to February, how many shares will be there? It will be 36 million and then the right issue, isn't it?
Yes. The right issue.
Would that be 42 million? The right issue is 146. So 1/6 multiplied by 36. So we are going to be getting 6 million from the right issue.
Okay.
Okay, plus the 36. That will give us 40.
42.
Okay. So we have 42 million here. So let's go and this is the right issue. We need to calculate our theoretical
Extra price.
extra price. Okay. So let me name this one to be approach one. Okay. We have so many ways of killing a cat. Okay. So let's come here. So let's have the existing shares. Existing shares. We are bringing 6 of the existing shares for 1 of the right issue. So 6 and the right issue. We have done this yesterday and we have explained it how we go about it. So the existing shares are currently trading at what?
Thanks to this.
Okay, 10 cedis. And what is the right issue price?
7.
Okay, so this will be 10 cedis. The total will be 60, isn't it?
Yes.
And this will be 7. So the shares on unit level is 7. And this will give us what?
67.
57.
67. So our theoretical XY price, XY price is equal to 67 divided by 7. What are we having?
9.57.
9.57.
Is it exact figure or you are approximating?
It's an
Approximating is
approximation.
Don't approximate. Okay. So we have 67 divided by 7. Okay. Let's
Okay.
have 67 over 7. So let's calculate our right issue fraction. Okay. Our right issue fraction will be the what? The share price before the right issue, which is 10 cedi, divided by 67 over 7. This will give us 10 over 1 multiplied by 7 over 67. This will give us 70. Is that correct?
Yeah, 70
Oh.
over 67.
Or 70 over 67. So what you do over here is that you apply your right issue until the date of the right issue. So you come here, this will be 70 multiplied by 70 over 67 multiplied by 3 over 12. Is that correct? 70
Yeah.
over 67 multiplied by 9. Is it 9 or 7 over 12, isn't it?
Yeah, 7.4.
And this will be 2 over 12. Okay, let's do all of them and get the answer. 30 multiplied by 70 over 67. The first one is
7.84.
okay.
7.84.
7.84 for the first one.
Um, 21.94.
21 point.
94.
Okay. And the last one is what?
7.
Is 7.
Yeah.
Okay, the total is what?
That's 6.78.
The total is
Yes. 36.78.
36.78. Okay. So you have divided by 36.78 shares here. What are we having?
44.59 pesos.
Okay. 44.59 US per share. Okay, let's look at what we have to do again. Okay, we are saying that the share price supposed to be what? The share supposed to be issued at what, 67/7, isn't it?
Yes.
Okay, but this has been issued at what, 7. So what is the difference there?
The difference is 18/7.
18.
Over 7.
Over 7.
Okay, so it means that the bonus issue element is what?
18/7. Okay.
Okay, so the bonus issue element is 18/7. Okay, what is the bonus issue? What is the bonus issue? Okay, the right issue, the shares from the right issue is what?
6 million.
The shares from the right issue is what?
It's 5
6.
million.
No, please.
6 million.
6 million.
The shares from the right issue is 6 million. Okay, this particular 6 million, let's divide it. There will be, it will be 30 million on the existing one. There will 30 million of the existing one, and what? 6 million
6
of the
million.
what? Of the right of the
Full
of
issue.
the full issue. Okay, let's come here. So let's come and determine over here. So let's look at the right issue on the existing shares first. Okay, so this will be on the existing shares. So existing shares, the right issue will be 1/6 multiplied by 30 million, isn't it?
Yes.
Okay, what are we having?
Yes.
5 million.
Okay, so that 5 million. So that 5 million, what we do is that this will be shared. You can see this one is actually a fraction. So separating it will be something difficult for us, but let's see what we can do. Okay, it's actually a fraction. Okay, so this particular one, the is actually a fraction, so that is going to be taking our time. But how we are, let's see what we can do. So we have the okay, so this will give us 5 million. Okay, but we know that the total market value should be 67/7. Okay, right market issue, full market issue will be 7 million, and the bonus issue will be what? 18/7. So the proportion will be 7 is to this particular one. So we have to have the bonus issue here. The bonus issue on that one to be 18/7 divided by 67/7 multiplied by 5 million. Okay, so we have 18/7 multiplied by 7/67 multiplied by 5 million. What are you having?
So 18 on 60. Oh, sorry.
Okay, multiplied by 5 million. What are you having?
90 on 67.
Yeah,
90 over 67.
or just make it as this is a this this is number of shares, so just make it as a fraction.
1.34.
Okay, 1.34. So the bonus element on the first one is what? 1.34. Okay, let's come to the bonus element on what? The bonus element on the full market issue also. So that will still be 18/67 multiplied by 1 million. Okay, the bonus issue from that one is 1 million.
0.27.
0.27. Put the two together, add these two.
1.61.
Okay, so it means that the total bonus fraction from the 6 million is this one. Okay, let's come here. So we have our weighted average number of shares. We have the existing shares. Okay. The existing shares will be there for a full year, isn't it?
Yes.
Okay. So that will be 30 plus the bonus what issue 1.34. Okay. We'll be having 31 point what?
34.
Okay. Let's come to the full market issue. The full market issue will be there for how many?
7 months.
No, please. The full market issue
9 months.
that yeah, it will be there for 9 months. So that will be 6 plus what? 0.27, isn't it?
Yes.
Multiplied by 9/12. And the full market issue from the right issue. What will be the value now? Full market issue from the right issue. That will be 6 minus 1.6. What are we having? Because the total bonus issue is 1.34 plus what 0.27. And that will be there for only 2 months, isn't it? That will be there for only 2 months. The market issue portion of the right issue will be there for only what? Only 2 months. That will be January and February. Okay, let's get the figures. This one is because it's fraction, that will be somehow for you.
The right issue is 0.73.
0.73.
73.
Okay. 6.27 multiplied by 9/12.
That's
4.70.
4.70. Put all of them together.
That's 6.77.
36.77. Okay. It should be the same as what the so you can see that it's 36.78. The one that we have gotten first is 37.78, isn't it? From this one. Okay. But this is 37. So they are all the difference is only that it's only the 7 or maybe because of the approximation. Okay. But
Yes.
for this one, I would advise you that just if you are comfortable with this one, you can pick this one. But this one to determine which shares will be there is always a problem. Okay. I want to add a third approach, but let's move on. I can see that some people are not saying top. It's normal. Okay.
No,
So
but Linus,
yes, please.
please, my confusion is the right issue. How did you guys get a 6? I'm confused.
So it's true that some people are not saying top. Okay. The right issue is made on the date. I hope you are the one who read the question. When was the right
It
issue made?
was made on 31st December.
Okay, and the right issue is made to what? Existing shareholders, isn't it?
Yes.
At that particular date, what will be the total number of shares in existence or in issue for the company?
36.
That will be the 30 that they have from the beginning and the 6 that they have issued on 1st May 2015. So the total number of shares will be what? 36 million. Auntie Ruth, Auntie Vic, are you okay with that one?
Hmm. Okay, yeah, I think I get it now.
Are you okay?
Somehow, but don't worry. Somehow.
This early morning, what are you thinking about? The entity
Nothing
has
really.
from the beginning 30 million shares. Okay. On 1st May 2015, they have issued additional shares of 6 million. So we have 30 million shares. That is the shares that we have from the beginning. That is the shares that we have sold from the time that we registered the company up to now. We have sold 30 million. On 1st May 2015, we have issued additional new shares, which is 6 million. So the total number of shares will now be 36 million for the company.
I get it now. I get it now.
Okay.
Thank you.
Okay, let's speak. I have, let's see, this minutes. Okay, okay. So I don't want to go further because uh just pick the one that you are comfortable with. I have another one of doing the right issue. So we have shown all the three yesterday. Okay, we have shown all the three yesterday. Which one am I going to solve now? Okay, let me check if I can solve. Okay. I can no longer see the questions here. Okay. My question is blank. Is it the same for you?
No, it's showing here. No, okay, it's A. In between is blank.
Oh, don't worry. Is the maybe the Abdul Quida? Something. I'm coming. Let me do this and come.